The Federal Reserve and Jerome Powell just shocked the markets. A 50 basis point cut is usually reserved for recessions, so are we in one already in 2024? Well, in today's video, we need to look at market structure, dark pool transactions, and of course, the key levels that will really make or break these markets as we face off on the biggest resistance point across the NASDAQ, S&P 500, and Russell 2000. So many markets hit key levels into the event and then continued to hold around them. But did we just see retail get trapped? One thing's for sure, crypto is starting to break out, and we need to talk about everything to do with stocks, cryptos, and commodities moving forward together. Let's get into it. See you in a moment. Well, welcome back everybody to The Daily Show. My name's Tom, and in today's video, we'll talk about this 50 basis point cut and obviously where the flows are starting to move in the markets. Have we seen any big transactions? Well, the answer is we've started to see a couple come through, and we'll continue to track them over the next few days. And this will be the big important thing because markets often digest news in a different way to retail traders. Day one can often be the overreaction day, that is today. Day two can often be the real move. And day three, we find out what the market really thinks. Now, remember, day three is actually this year on Opex. So it may be actually Monday next week that we start to get further clarity on what the market structure is starting to appear. Will we break through some of these resistance wicks, specifically in stocks like Tesla and the S&P 500, and really begin a massive ramp to the upside? Or are we still looking at 5,500 being a very key buying the dip style support? Well, it's key to be staying patient, react, don't predict. And for anyone that's been viewing this channel for a while, you'll know that they are the words that we live by when it comes to trading and investing. So let's now take a look at the Fed statement and of course what Jerome Powell had to say about the markets. Now, first off the bat, I did think a 25 basis point cut was probably what we would expect, as did many. But as I mentioned, it's probably not as important as we usually would guess. 50 basis points generally is reserved for recessions, but we'll talk about that a little bit later on. This is clearly some type of neutrality being formed by Jerome Powell and the Fed, but we also need to consider it's an election year and maybe that has to go into it a little bit. Yes, I know they're not meant to be political or anything like that, but let's look at everything that's going on down below. We don't think we're behind on policy, Jerome Powell says. We think this is timely and you can take this as our commitment to not fall behind. Now, of course, Jerome Powell and any central banker will always say this type of thing. This is on calls that they should have already done a rate cut earlier. And of course, when they start to see the labor market weaken, that they're behind the curve. And this is another argument for why 50 basis points may not be as scary as some people may think. Also, another good quote here from Jerome Powell was the labor market is in a solid condition. The intention of our policy move today is to keep it there. That's what we're doing. So this is about labor. This is about trying to get those non-farm figures towards the levels of what the Federal Reserve wants to see. And these are all the changes that they made to the statement. And you can see here there are quite a few changes if you want to pause the video here and have a look through all of those moves. You can also check this out on our X account, links in the description down below. Now, some things that were most interesting about this was, of course, there was one Fed governor, Bowman, that actually said, I don't want to do 50 basis points. I want to do 25 basis points. That's the first dissent by a governor since 2005. This is also the first 50 basis point cut, the way that we've seen it, for a very long time. Of course, we had the 2020 period, but the last time we saw it before that was, of course, the global financial crisis. Now, FOMC participants' assessments of appropriate monetary policy really are pointing towards basically further cutting and some form of terminal rate somewhere around 3%. Now, if we actually take a look at the curve here and we think about what's going on from interest rate cut decisions, we've got this now appearing in the markets. A total of another 185 basis point cuts by July, August of next year. And that's some extreme cutting. And of course, the markets in some ways are starting to get into a curve that may look like a recession. Now, here's one from Todd McClellan in terms of the 2-year versus, of course, what the Federal Reserve does. And we've argued for a little while that we may be in that 1999-98 period style market, or even the 2018-19 style market, where the Federal Reserve begins cutting. They're cutting into a hot economy, into a strong, actually fairly robust economy, and that we have a little bit more to run. Now, we'll look at those stats in a moment. And of course, market structure will be all important over the next month, specifically post mid-October, which is often where we see the kind of lows and the most volatile period of the US elections come through. But what this chart is really showing you is the US 2-year is often in front of what the Federal Reserve should already be doing. And in many ways, when the US 2-year has gone absolutely ballistic towards the downside, it has been a kind of precursor. But we must remember it's not always that way. Back in 98 into, of course, the 2000 period, the market 2-year was freaking out, did get some cuts, but then it became clear that, oh, we need to actually raise them back up. And then, of course, we had an oopsie moment and everything turned into a bubble and crashed. The central bankers and governments will do anything that they can to stop a recession. And we need to keep that in the back of our mind as we move through this next couple of months of structure. Keep an open mind to both the upside and the downside. And one thing I've said on this channel many times before is of my kind of 7 recession style indicators, I'm not seeing enough of them flashing red to say, wow, I'm terrified. I am seeing enough of them showing us that we're in late cycle. And this will lead further into gold and potentially utilities and even healthcare stocks doing quite nicely, potentially over the next 3, 6, and even 9 months. And obviously our gold call still continues to be quite well. 2,600 reached, by the way, and then dropped after that rate cut. Rate cut like this, not bad for gold if we think about it. All right, let's look at current pricing versus recessions and non-recessions. This is a little out of date now because, of course, now we have even further rate cuts expected by the markets. But how the trajectory moves over the next kind of 1 to 3 months is important because, of course, this is what the market's going to be looking at, a recession or a non-recession path. And this can be shown in market structure. Now, somebody actually reached out to me on X, this one's for you, where you were basically saying, I want to see the chart with a recession and a non-recession. What does the market tend to do in both of those situations? So funnily enough, in non-recession periods, markets actually tend to fall around this period of time, then find a basing kind of kangaroo, and then start to rise up about 1 to 2 months after the cut itself. In recessionary markets, often what will happen is we'll get a little bit of a fall, we'll raise up, maybe even make a new high, and then dump around 2 months after the actual cut itself. And that begins, of course, a recessionary period. So the market structure will be all important. And as we've seen several times, at the moment, it looks like most economists and most people are lauding the soft landing. This is something you want to see if you're a bear, actually. If you're a bear in markets, you want people to say, we have achieved a soft landing. And I think the thing about achieving a soft landing is you must see a rate cut like we just saw. Then you've got to see a market make a new high, do a great thing, all fantastic, look how good everything is, and then it'll explode. So remember, you've got to really think about it from the perspective of we need to suck as much money in as possible if you're a bear in the markets, and you need everyone to believe that. If you're calling for that big recession, that one that could lead into a 50% drop, you do need everyone on the side of the bull FOMO. And we're not quite there yet, as I've said, with many of the key metrics. Let's now have a look at US election years and the back end of September into October. We obviously know this is where the kangaroo can exist. This is some data from Bank of America, and you can see here that this is often where we go up, down, and all around into the back of September and into potentially October. And you can see that the back end of September is usually the worst part. And if you look at average performance that isn't election years, it's particularly bad. In fact, election years aren't as bad on the back end, but we know this year we've got all sorts of data stats from people like Fundstrat, Tom Lee's Fundstrat, that are pointing towards the back being bad. We've also got a lot of people discussing October being a very volatile month. And this makes sense. The Volatility Index suggests that that is true. So when we see cuts at all-time highs, is that a bad thing? 50 basis points is basically unprecedented. That is a huge cut, but it does bring us back into, I guess what you would say is a more neutral term, around 2% above inflation. That's about right in terms of where the Fed should usually be. Now, when it comes to performance within these highs, you can see here Ryan Dietrich over on X has actually gone through and looked at the data stats. Now, I've seen some people fighting about this and saying, yes, but we got a cut near all-time highs over here, and then that turned into the global financial crisis. Obviously, like any data point, There are metrics, and of course there were cuts here as well after we went down from the all-time high. I think it was a bit different in 2000. So there are some points here where maybe we were cutting near the all-time highs, but not at the all-time highs. So this is an amazing stat because 12-month returns here were 100%. More importantly, though, the kangaroo market was really intact still in these reads. Only 45% of the time was the market bullish over the next month. And that's going to be good for short-term bears in terms of some of the transactions and things that we've seen moving forward. Earnings insights, do remember, yes, earnings is just around the corner. And we're continuing to see the big economists out there, the big kind of banks saying, you know what, I think earnings estimates and valuations are going to go up. And of course, if this happens in October, because yes, we're coming up to these earnings, it's going to mean a big deal. Magnificent 7 in particular is getting some EPS upgrades here, buybacks from, of course, Microsoft recently, and all of these things start to help. But do remember, we were in a buyback window. We're now out of the buyback window into October. This period of time can become volatile because of that, because we're no longer in that area which being, hit with $4 to $5 billion a day of just net purchases by the street itself. Equity and all of these good things, that is not looking like leverage is actually at a max yet, which is again a bit of a warning sign if you were to be bearish. And that's just not what we're seeing here in the markets. And we do need to remember as well that new advanced decline lines are still improving when it comes to the markets. S&P 500 advanced declines up. NASDAQ 100 advanced declines up. These things do matter. A movement from a negative 3% week to a positive 3% week is also a pretty good thrust sign. So I think from the bulls perspective, considering that we have a pretty decent upward trend here, there is a case to be said that if markets do fall, especially to levels like 5,500 or even a little bit lower, that there are still buyers around. And even with the 50 basis point cut, which has been synonymous with absolute negativity over the next kind of 1 year base, we have to consider where we are at. We're not seeing negative growth jobs. We're not seeing necessarily a market that's already tanking itself. The market hasn't told you, oh, we're sick, and then the Federal Reserve has reacted to that. And while I probably would have liked 25 basis points to keep the soft landing narrative, 50, whatever, it doesn't really matter. We have to consider what the market structure does. Leave our opinions at the side, leave the data at the side, and look at what the market's doing, not what everyone else is telling us. When we move over here, we can see the stats for the next week theoretically should be bad. And this becomes quite important when we're considering as well structure. Fast cycles versus slow cycles. We've talked about this for a while. Grant Hawkridge has actually put out a bit of a chart here, which specifically looks at 50 basis point cuts. And the interesting thing I found about 50 basis point cuts is in these cases, right around the first cut, sometimes we sold instantly, but we actually, both times, actually found new highs. Now, if you look at the 25 basis point cuts, the ones that actually turned out to be way more bullish, they sold more aggressively or went kangaroo. And they just basically sat around the same level before going to new highs. I'll be watching this. I'm sure we all will. And we will watch this structure very, very closely. Let's move over now to a couple of dark pool transactions. First up, we saw this ahead of the FOMC event. Some large 3 times leveraged funds that probably are gearing towards the sell end. So there were 3 that came through in different funds. They were ahead of the FOMC. Post, though, we saw Amazon with a large transaction. You can see here that when we've had large transactions on Amazon, they have marked kind of near highs or near low points for a little while now. Interesting one coming out. We didn't see too many others. NVDA had a couple on it as well. We will track them as I believe we're going into now, of course, the Opex. The Thursday, the day before the Opex, can be the most volatile. And that's, of course, the session we're leading into. When it came to up, down, and all around, you can see the initial reaction and how the press conference went and took that off. This is standard for big news days. Up, down, all around, trapping people into random liquidity and screwing them over. And of course, this brings us now to look at the S&P 500. Now, on the surface of it, we went and made a new all-time high, and then we sat all the way back down. And why is this? Well, because we know that 56 kind of 40 is a positive gamma situation. If the market holds above 56.40, there was a good chance that we would continue to see squeezes post-market and, of course, into the next session. And at the time of this recording, the futures are all absolutely skyrocketing up, even though this looks like a really negative candle. Advanced decline line actually was up for the session, showing you the underlying really liked it. Russell 2000, small cap stocks, medium cap stocks like a bit of an interest rate cut. And if we now break through 56, kind of 70, 80 level with a daily close, this is going to be a huge deal, especially if a weekly gets above as well. It's going to signal that all pullbacks are probably going to be met by bull demand for the time being, and that the bulls could be in control of this market moving forward through October. Now, here is where things get really interesting when we look at the future structure. It's not bad that we're actually recording at this time, because we can see here the futures are ripping higher. And to get really a bear bust, to get a bear sell into something like a 5,500, we've said this in the previous video and we say it in this video, probably needs to be underneath 56.06. So with the market ripping so much during futures, there could be a lot of suck in here. There could be a lot of FOMO, people going 50 basis point cut, yeehaw, let's go. Of course, we know we're at that resistance. We know we've now put in two structures, and there will be some specific stocks that we'll look at in a moment that could really benefit if the market does end up ripping higher. Tesla, anyone? Yeah, that one has now got two rejections at the 230 level, which are key. Let's now look at the S&P options flow. So you can see here 5,500 becomes important for the 19th and, of course, also the 20th. And we'll also note that there are quite a few puts that came through after the announcement from the Federal Reserve. So where do we really move super positive gamma in the next session? Well, 5640 to 5700, this level that we've been talking about a few times. Puts, though, start to appear heavily under 5606 in particular. And there's a lot of kind of, build up there around that level. So that's probably where you're starting to move towards the negative gamma side of the markets and actually pushing the bear narrative. So we're still stuck even after. And that's why so often you'll see an overreaction. Then day two, you'll start to see the real move of the market, what it wants to do next. When we go to the Friday, you can see here that again, 56, kind of 50, 56.40 becomes the key level for massive positive gamma switch. There's a lot of calls there still around the markets. What an interesting time here when we're going through the next 2 weeks, particularly from the options market. NVDA came down to the 113 level, probably no surprise. That's exactly where all the calls expire this week, which you can see here. And 110 remains kind of like the temporary base put support. But 230 remains a massive issue for Tesla, a call level that continues to be massive throughout the next couple of weeks, seems to be held down at this stage because probably the street doesn't want to pay it out. And you'll see here 230 is a huge deal when it comes to these markets. Let's now move over to the lead indicators. What are we seeing? The VIX obviously spiked up 3.52%. No surprises there, but the volatility of the VIX, so this is often the one we look underneath the hood at, that actually spiked massively, then dropped straight back down. So this is showing you that there is volatility in this market, and there was, of course, a bit of a freak out there by the market in terms of VIX, but we're back now to stabilization until we break the key levels. The US dollar ended up bouncing up even with a 50 basis point cut and hitting around the daily 20 moving average. If it manages to close above the daily 20, I could see dollar bulls actually start to come in. This is a very significant switch day because, of course, 50 basis point cuts, you're always going to say, wow, that could mean that the dollar is going to die and go down to 99, 98. It has to go down. Yet the reaction was, of course, opposite to that. And this is why you want to look at the price action. It took the low, swept them, bounced back up, and at the moment actually looks relatively bullish on small timeframes. Because it isn't above the daily 20 though, you can't say, oh, it's flipped the switch and going towards 103 just yet. I would say a pretty big dollar trade will come up though over the next coming sessions. And at the moment, you would have to say pullbacks will be met by bull demand on the dollar. And that's interesting because if the dollar starts bulling, could that mean the bears are coming back to the stock markets, even though the futures are right up right now? Copper, let's have a look here. We can see that this is right around that resistance area, continued to hold. Would be okay to stabilize here. Like to still see 450, 460. With the Fed going a 50 basis point cut, they open the window as well to that 1970s narrative, which we'll go through in the next video. A reinflation story that could come through. And that would be quite timely for a lot of these metals trades that we've seen some nice recoveries on in recent times. US oil didn't move as much as you would expect, still finding problems with the daily 20 moving average. Of course, if it breaks through like a 71.60, it's probably going to around 74 a barrel. And this area here will be our next target in what has now been a decent recovery for that particular commodity. Let's move over to gold, 2,600 achieved. We know that was a very key level for gold, and then it bounced down. Of course, at the moment, it's trying to get back up. Strong dollar, if that is what the markets choose to do, could push gold down and get some people back into nice buys. I actually think this is a very strong position for gold. I know, yes, oh wow, the next reaction looks pretty bad and GDX looks pretty bad and stuff, but a 50 basis point cut, given that gold is actually a currency, the oldest currency, I don't think it's a negative thing for gold. And of course, there could be some very nice trades on this moving forward. Now that we've got this big rejection on GDX, we can look towards a break above this high as well, being a very strong sign. We'll follow that. Silver was down as well. Often it's been doing pretty well into a cut. We did talk about the idea, though, that it may have front-loaded this. And when it comes to silver, it hit the TP zone as well. So remember, unless silver gets through 31.50, you can't say, oh, wow, silver's going to absolutely explode to $34 plus per the ounce. And in this case, it came back down to what we call classic role reversal. A resistance becomes support. Probably the first major little or minor, I would say, support line for silver. Nice overall move, perfect kind of TP zone, and just shows you how accurate you can be with your great technical analysis when you look at it. Also, we hit that little bit of structure over here on the left-hand side. So for now, silver's still bullish. Again, I don't think a rate cut is necessarily bad for those metals, even though the market's initial reaction was up then down. Let's move over to Tesla. Now, this is an interesting one. I really like this chart now. I want to see a 235 plus break close. I want to see a daily close. That's a tweezer short. You look at that and every single person would say bearish, 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 bearish. Hey, it could be. And of course, if the market ends up going down past 56.06, then Tesla could become a bit of a target. I'm sure the narrative will be something to do with Elon and, of course, his ex shenanigans if that does end up occurring. But at this stage, we know that it could be an inverse head and shoulders. It could break to the upside. We're not going to use narratives. Instead, we're going to use price action. And I would say 223 at this point. If you go to a 2 hour, you can see that 223, kind of 224 level. A break below that could be, really bad for Tesla. NVIDIA struggling around like semiconductors are. I prefer the semiconductor chart at the moment, but didn't fill the gap. I don't think it's necessarily a shocking day for semis, but we do need to remember when we look at structure now, we're right on that level where semis have to buy up. And if they don't buy here and they start falling below, then we could be looking at least a 61.8 retracement of semis. And that would not be a bad zone at all for the bulls. And hopefully all of these things, remember, if this did happen, we got a 222 kind of level for semis, that could link up well with a 5,500 S&P. I like where this stuff is possibly leaning towards if we get the right triggers. Let's move over to HSI. Love this. Look at it go. Well, that's replication. And again, I understand people will say this sucks, the narrative. Ignore your narrative, follow the price action. Patience, react, don't predict. We talked about this incessantly for quite a long time now. And of course, we've talked about this turn event. And this is actually out of our day trading masterclass. It's a complete replication there. Very nice. First TP basically hitting right now in terms of a major zone. And this is a big deal. Now, could this be the turn of China? Well, I think iron ore spot will need to be looked at as well. And this is the thing with metals. Now that we've got a 50 basis point cut, you can see metals are reacting to that pretty positively because I think people are saying, well, this could cause reinflation. Downward channel at this stage. We'll keep focusing and keep looking at it. Aussie market loves the cut. Why wouldn't it? Energy, metals, banks probably not so great, but anyway, the rest is pretty good. 8166, new all-time high, pretty key. And speaking of banks in America, you've got to watch the XLF. We're going to continue to watch home builders, financials, all these market sectors that we know if a sickness is there, it'll probably start to show us it. Now, what about Russell 2000? Well, it actually hit our second level and nailed it and then went down. Again, these are all going to be defined by the next big thing. I know at the moment the futures markets are up and everything looks fantastic, but if the market breaks to a new high and closes, I think that's a significant flow effect to move on in a positive gamma situation. And of course, it could be big for the Russell because if we get past that 2300 zone, 2280, then we could be moving all the way to 2450. And that's quite a nice move indeed. And it would make sense to a 50 basis point cut, at least initially. But we do need to keep those data stats in mind. 5606 on the S&P is key. Let's now have a look at the NASDAQ. And specifically, I want to look at the Qs. Let's just look at the Qs here to see the closure levels. Now, the reason I want to look at this is because there's no clear break of what usually has been the leaders. See the major resistance, and at the time of the recording, we are right at that level again. Downward trend line, obviously a great level that we've nailed a few times. It's been coiling here after the news and during it. So if we do get a breach to the upside, that could signal we break through 490, then maybe pull back early October and move something like this, something we've talked about for a while. A pullback, we'll talk about that if it happens, major bull area. And again, a sync with 5,500 on the S&P would be key. So what a time it is to be in markets. Now let's move over to Bitcoin. Now that's a clear break. That's everything we've been talking about and the bullish trend change that's happening here in Bitcoin on the smaller time frames. It's not a weekly trend change. I know it's still down weekly, but things are improving big time. We like this candle. We loved it here. We like it still. I think it's pushing towards 64.5, 65. It's playing catch up, and it should like a 50 basis point cut, frankly. So this could be a good little catalyst. I think a lot of people were waiting for this, and little small retail money is probably trying to trickle in. Maybe some ETFs will start to buy in as well, and we'll check that out. For the news ahead, well, there's still other central banks to come out. We obviously have the UK central bank coming through. They're not expected to do a cut. Then we have the Bank of Japan policy rate, which could move US dollar yen. And there's still a bit of information coming out from other central banks and other economies around the world. If you enjoyed today's video, then please make sure to subscribe. Smash that like button, guys. Post in the comments down below. I've been loving your comments recently. Thank you. Sign up for the free newsletter. I'll get that one out within the hour. And obviously follow us as well on some of the other socials. If you're from Australia, check it out. Melbourne's really getting close now to filling. So if you want to come and visit us in Melbourne, totally free to do so. We're doing an event where we're going through some amazing data, and I think you're going to enjoy it a lot. Plus, it'd be awesome to meet you. All right, guys, that's it for now. What a day. Monumental, obviously history making, but maybe not the same as the global financial crisis or the big tech bust. And that's because we are at all-time highs, and that's very unusual to be negative, as we can see with the data. Catch up.